A tentative peace agreement between the US and Iran sparking a broad rally across global financial markets. What do things look like? Investors welcomed reports that the deal would keep the strategic Strait of Hormuz open, reducing fears of a prolonged disruption, basically, to global energy supplies. And the prospect of lower geopolitical risk triggered a sharp improvement in the market sentiment, and that's important, sending equities higher across Asia and lifting US and European futures. Japan's index gained 5%. South Korea's benchmark index surged 5% as well, while futures tracking the S&P 500 and Nasdaq also moved higher as investors rotated back into risk assets. The biggest market reaction came from the energy sector, of course. Brent crude dropped 4% to around $83 a barrel, while US crude fell nearly 5%. Although oil remains above the pre-conflict levels as such, the decline marks a significant retreat from the peak of more than $126 a barrel seen earlier this year. Lower energy prices are expected to reduce the inflationary pressures globally, particularly for the major importers like Japan, also Europe. However, analysts caution that uncertainty remains over shipping regulations in the strait and the extent of damage to the regional energy infrastructure. The decline in oil prices, though, is reshaping expectations ahead of that crucial week for the global central banks. Policymakers in the US, UK, Japan, Australia, several other economies, remember, are due to announce interest rate decisions. And with energy-driven inflation risks easing, investors are scaling back expectations of further monetary tightening. US Treasury yields moved lower, the dollar weakened against major currencies, and gold climbed nearly 2%. For central banks, meanwhile, the peace deal offers a potential reprieve from the inflation shock created by the conflict, although officials are expected to remain cautious until the durability of the agreement becomes clearer. To stay up to speed with the latest news, download the WION app and subscribe to our YouTube channel.